Good morning, everyone. Well, it's back. We can all stop worrying about the fiscal cliff now because we've got something even bigger to worry about, the debt ceiling. It's an amazing confluence of crises that allow us to bump up against the ceiling while going over a cliff. But apparently the English language is also going to be another victim of US politics as well as the US economy. Eurodollar never achieved our bottom target yesterday, but rather moved higher throughout the day. There seems to be some resistance at around 132.40, but I think the market's probably targeting this year's highs around 134.50, so there's still some upside. The important point to note is that Eurodollar moved higher yesterday despite the news from Mr. Geithner about the debt ceiling. This is quite different than what's been happening with the fiscal cliff talks. Disappointing news on the fiscal cliff talks tended to raise risk aversion, which paradoxically was good for the dollar. But the debt ceiling problem is unambiguously bad for the US. It's bad for stocks, bad for bonds, and bad for the currency. Last time this happened, in July of last year, the S&P 500 was down about 17% in 2 weeks, and the DXY dollar index fell around 3.3%. Elsewhere in the market, selling the yen remains the major trend. New Prime Minister Abe announced his cabinet overnight, and the comments from the new members indicate that they are serious about creating inflation and weakening the yen. I'm sure they'll try, and everyone in the market believes that they will try too, which means the market will remain a buyer of dollar yen. Putting these two trends together, we're now more confident buyers of Eurodollar, but still prefer to buy Euro yen. That's more likely to benefit on both sides of the trade, with a higher euro and a lower yen. The euro may gain against the dollar, but we have a hard time envisioning the yen gaining against any currency for long. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.